Test, test. There we go. Okay. Looks like it's our end. Let me end that. Okay, I mean, the technology is always good. It's all set up again. Log in, your PC account, I got all my Google account, I got all my Canvas account, and I got my business courses class account. So it's been a couple weeks since we met. The exam, I think it's open through tonight, but most everybody in class is taking it, and the scores were very good. So I don't know if that's an indication of how well everybody's doing, or an indication of how prevalent answers AI is. But you let me know after the semester is over how that. Tonight I want to hit on LIFO and FIFO accounting for inventory. I want to walk through LIFO reserve, understand a little bit about how that changes the ratios of everything that we've been looking at in class. Any questions before I just launch into a lecture? That's good, homework good, research projects. Probably haven't made any progress in the last couple weeks. Maybe? Nah, okay, that's typical.
I'm assuming back on track with the schedule. Kind of weird.
Schedule's up to date. I had to travel, so I had to miss the night. If it changes again, I'll announce an announcement. If it's been confusing, pick me up. I'll let you know I'm available. You can email me. So if you ever don't know whether or not we're having class on a particular night, first check syllabus, but then just shoot me a text. I'll let you know. Okay, so tonight we're talking about asset recognition and operating assets, which really just means we're talking about inventory. We're going to hit on depreciation a little bit, but that was also largely module 5. And then our authors throw probably half a dozen topics in at the end of this lecture, just because they don't know where to put them in the semester, and they're significant, but not so technical in nature that I would expect any of you to have any real problems digesting the material. So we'll move pretty fast when we get towards learning objectives 4, 5, and 6. Somebody else just chimed in, so let me make sure.
Hello.
Hello, can you hear okay?
Yeah, I can hear you perfectly fine.
Okay, great. Well, and I can hear you just fine too. So if you need to ask a question while we go, just interrupt me.
Thank you.
All right, so right off the top, I want to talk about inventory and how inventory ends up on the income statement. High level question is, when we go out and buy inventory, that is posted to the financial statements as an asset. My question to you all is, why don't we just expense it?
You wanna match your expenses with the revenue for the last from the report.
That's the answer. It goes all the way back to day one of your accounting 101 class. It's the matching principle. These financial statements are useless unless we can report back to the shareholders and the bank and the creditors how much we actually earned in a given period of time. And in order to report that properly, we have to match the expenses that went along with those revenues during that period of time. So when we sell inventory, the question is, well, what inventory did we just sell? That may have been sitting on our shelves or in our factories or in our warehouses for, sometimes you'll find that sits there for years. And how do we cost that? You know, what expenses do we put on the income statement when we're actually looking at that inventory? So from day one, we're gonna make a very simple accounting transaction where we credit cash and debit inventory. So cash goes out the door, inventory comes in the door. Those are both balance sheet transactions, and inventory ends up on our balance sheet as an asset. And then we're subsequently going to move it from the balance sheet to the income statement as we match it with those revenues that are ultimately sales. And that matching principle is the calculation of cost of goods sold. And that cost of goods sold is as simple as it sounds. If we buy raw materials and we push them through a manufacturing process, we're going to have the cost of the raw materials plus any of the additional materials that we assemble those widgets with, and the cost of direct labor. So that's 1, 2, and 3 at the bottom of the slide there. 1, 2, and 3 would seemingly make a lot more sense to expense immediately, but again, we have to match those with the sales that we will make in the future. So we gather up all those costs, put them on the balance sheet in that inventory line item. That inventory line item just catches all of these expenditures. Those expenditures ultimately end up on the income statement when those goods are sold. Okay, I'm just gonna go straight to an example here and skip the definition because the example is self-apparent, or I hope it is, as we walk through this. So in this problem, we have assumed the following inventory records, and we want to look at inventory that's available on January 1st. We have 100 widgets, 100 units, or 500 units at $100 per piece. That's what we purchased them for. That's the addition of any additional raw materials. Those are manufacturing costs. So think of that as what we purchased them for, or assembled them for. 500 units at $100 a piece is $50,000 in inventory. We have inventory purchased during the period, 200 units. We purchased those at $150 per unit. Cost just went up by 50%. So that we're walking through a pretty simplistic example here. And one of the reasons that it's simplistic is not very often are you going to see a 50% increase in costs. But during COVID, if you look at a 3 to 5 year period, we did see 50% increase in cost. And that's the primary factor that influences inventory costing. And the reason we have LIFO and FIFO, and we devote a whole class to it, and the differences that come out of the various accounting is because inflation can make a big difference on those inventory units that are just sitting there in our warehouse. And you'll see that as we walk through them. So the total cost of goods available for sale, 700 units, is $80,000. We're going to match those against inventory units sold during the period. 450 units were sold, and we sold those for $250 per unit. So we already had a little bit of a mismatch here. I see students get hung up on the formatting of these questions, because in the top half we're talking about inventory, which is cost, and in the bottom half we're talking about revenues, which is sales. So those aren't apples to apples, but just keep that in mind. The 250 applies to revenue, the numbers above apply to cost, LIFO inventory costing method. Our sales are 112,500, and our costs of goods sold using a first in, first out methodology is going to capture these inventory units in the top line that came in first. And we're going to send those over to our income statement because they're also going to be first out. So we capture 450 units at $100 per unit, and that makes our cost of goods sold line $45,000. And you can see how that affects our gross profit. Gross profit is ultimately going to affect operating profit, earnings before interest and taxes, going to affect taxes, and ultimately net income. So that all flows through. This one calculation, cost of goods sold, fundamentally changes the whole face of the income statement. Okay, easy enough. Now let's look at the LIFO costing method. And all the numbers are the same here on the slide, except for this line here. So the sales number is identical, 112,500. But now we're using the last in, first out method, and we only have 200 units that were cost at 150 per unit. So we know we want to take those units and send the cost of those units over to the income statement, but we only have 200. So where do we look after that law? Well, we sold 450, we just cost 250, 200 at 150 per piece. We have to assign the cost of the next 250 units at $150 per. That all adds up over there. So now we have 450 units. The first 200 were at 150 per, the next 250 were at 100 per. That totals $55,000, and your gross profit is $57,500. That's quite a bit lower than what we saw on the last screen. So we just took our gross profit from 67,000 to 57,000. So that's 10,050. That's not quite a 20% difference in your gross profit. So I opened this class by explaining that all semester we play this little game of follow the penny because we're trying to figure out, you know, if you wanted to manipulate the accounting, if you wanted to trigger your stock option package, if your incentive comp was linked to earnings per share, how would you trigger some of those incentive packages? Well, LIFO to FIFO can change gross profit and therefore net profit by 20% in this example. And I think you'll find that's not uncommon. Now, how do management teams shift from LIFO to FIFO? So this is, if someday you need to do this, or if we're playing this game of follow the penny, you got to know how to execute it.
Are you asking how they, like they have to get approval to do it, or don't they have to get, or announce it, they've done it, and then it's prior financial statement to show what it is?
Yeah. Pretty much, they just say they're gonna do. And then there's some disclosures that they have to file, the next technical filing, they'll be disclosures that, you know, in this year, we can comply with the FIFO, and that affected our earnings by 20%, and here's the restated numbers. If you want to go back and compare apples to apples, this is what it would look like. But they don't have to go out. You just do it. It's like waving a magic wand, tell your auditors to make sure they have all the proper disclosures in there, and it's done. And this is your new account. You just increased your earnings by 20%, which is really pretty phenomenal. And that's what I try to clue in on as we go throughout the semester, because a lot of accounting is exactly that, estimates. A lot of accounting is forecasts, and it's at the discretion of management to pick the number that they see as best fit. And unfortunately, what management thinks is best fit might be best fit for them as managers with incentive packages that have been awarded to them. That's not best fit from a shareholder's perspective. if you think like an owner, that field of accounting is really meant to present an accurate reflection of the true underlying economics of a business. So which one of these is a better and more accurate reflection of the true underlying economics of the business? Is it LIFO or is it FIFO? Depends a little bit on the business, but just if we're just making generic widgets, and you own it, and you're just trying to better understand your business. You always got a warehouse out there full of widgets. Some of them are gathering dust, but the truth of it might really be that it's FIFO. The inventory comes in first, and we have an assembly line, and it comes out, and that's a more accurate representation. Or it might be that you have like a coal mine or something, and you know, there are widgets out there just gathering dust. And LIFO is a better representation. Now, I think what you'll see next is that owners do have some conflicts of interest, because while the accounting field has a field of study, sets as its goal to present an accurate underlying economic reality, as an owner, it just makes sense to select LIFO where you can. Like in this instance that we just looked at. Okay, LIFO was 57,000 in profit, FIFO was 67,000 in profit. Neither one of those, these are just numbers on a piece of paper. So if these are just numbers on a piece of paper, then as an owner, you want to pick the one that's going to put the lower gross profit number on a piece of paper, because now you just decreased your taxes by 20%. And taxes is a real cash outflow. So if you can save money on taxes, then you want to pick the lower number. And you can see that conflict of interest there between anybody that's incentivized to post a higher number versus somebody else that might be incentivized to post a lower number because they're concerned about cash flow.
Asking for a credit
That's a great question. My company has a credit line with the bank, and as a condition of having a credit line outstanding, we have to adhere to certain covenants. And one of the covenants that we have to adhere to is a fixed charge coverage ratio. Fixed charge coverage ratio is a cash measurement of your earnings. So it wouldn't be affected by the accounting LIFO FIFO. But other companies are subject to other covenants, and those covenants can run the gamut, just like incentive compensation plans can run the gamut. Banks can choose to hold companies accountable to any sort of metric they want to. So if they're looking at net income, or if they're looking at some other ratio that is affected by this accounting, then absolutely it might affect your ability to take on credit. That's a good insight. Another methodology that you see sometimes, I haven't seen this very often, it's an average costing method. And just to be clear, there are more methodologies than LIFO, FIFO, average cost. You have specific costs, or we're going to look at retail methodology. Check the 10K filing of whatever company that you're doing research on this month and find out exactly how we do this. I think I used the example of Boeing earlier in the semester. I had done some research on Boeing earlier in my career, it's been a long time, but they had a procurement method of assigning costs to the planes that they would sell. And they looked at the entire cost of the program from setup to delivery, because they had to build specific facilities to what at the time was to create a carbon fiber fuselage, which was going to save 30% on fuel. All the costs that went into that were 7 to 10 years worth of accrued inventory that they had to pass on to the income statement when they expensed those planes. And it was very sophisticated and cumbersome. It was a challenge for a young analyst like me to understand, and I suspect that some of you in this room are probably looking at companies that'll bring similar challenges. But average cost is pretty simple. Every inventory unit that moves from the balance sheet to the income statement is cost at the average of all inventory on hand. So units times cost divided by total units equals average cost times units sold. Retail inventory costing method. The next slide here. If you're a retailer, most retailers now can track this by SKU. Their inventory systems are sophisticated enough that when you scan something at the register, they know that unit is out of inventory and has now been sold. They know what that unit is cost at, and they can line those two things up. This is a different methodology where we're looking at this might show up in a multiple choice question, but I've never seen this. I don't know about a lot of retailers, but I've never seen this one in practice. In this instance, our authors are walking us through cost of goods available for sale, calculated as a percentage of cost to retail. So if we have inventory that costs $400,000 and we just sold $660,000 worth of new merchandise, that cost to retail percentage is 60.6%. So we can use that to calculate the estimated ending inventory at cost. We know that the cost to retail percentage is 60.6%. Multiply that times the $240,000 retail value of the inventory on hand, which would indicate that we have inventory priced at or worth $145,000. So that's the number that would end up on the balance sheet. The point there is that this is one of what could be another half a dozen different nuances or subtleties to costing inventory. Check the 10K for whoever you're working on and make sure that you understand exactly how they're costing their inventory. This is a good example. A good cheat sheet too. You want to star this one. The first bullet point kind of gives it away. In periods of rising costs, which is exactly what we've experienced in the last 5 years, LIFO inventory can be markedly lower than FIFO. So when that happens, we know that there's a whole bunch of expenses that has run through the income statement that would not have run through the income statement if it were FIFO. Those expenses lowered profit. So if we had used FIFO, which is what international accounting demands, FIFO is not even an option in international accounting. So if we had operated like everybody else, we would have reported higher profits over time. FASB recognizes that difference, and to correct for it, they require companies to report something called a LIFO reserve. The LIFO reserve is the difference, the accumulated difference over time between LIFO and FIFO. So you can think of that as this is all the profits we would have reported if we had been on the other inventory costing system. All the accumulated profits just sitting there in LIFO reserve. It's not exactly right. Because you have to tax it, but it's close. So take a look at this disclosure at the bottom. It says, well, we state inventories at the lower of cost or net realizable value. I think we're looking at Home Depot here, I forget. Last paragraph. If the FIFO method had been in use, inventories would have been 3 billion higher than reported at December 2022. Okay, that's a little confusing. Inventories would have been 3 billion higher. Well, in order for inventories to be 3 billion higher, that means we would have not transferred 3 billion worth of expenses to the income statement. If we didn't transfer $3 billion worth of expenses to the income statement, then that wouldn't have been taxed. And our profits would have been higher by probably 2 billion, depending on our tax rate. So it is worded a little oddly, but those are profits just waiting to be had. If at any point in time, management says, we want to realize those profits, they can just change their official accounting system from LIFO to FIFO. All those profits immediately flow through to the income statement. It's like, this requires certain disclosures and restatements, but they'll be taxed at that point in time, and you'll get a big windfall. Lower of cost of market is a simple one. I suspect everybody in this room has probably made heard of it in the past, if you've not ever dealt with it directly. At the end of the year, accountants are required to take some assessment of how much their inventory is worth. And if it has fallen in price to the point where it's now worth less than what's stated on the balance sheet, then we're gonna have to take an impairment cost. So this can be a simple write down of inventory. So we take a loss on inventory that flows through to retained earnings. And then we have so it flows through to cost of goods sold, but that's not how you would see that's not how you would see the accounting entry. You would see the accounting entry posed as a loss on write down of inventory. So that would be the expense that posted through to your income statement, and that would reduce the cost of goods sold in that particular instance. Okay, this is a likely test question. If you want to start the slide. And again, these are the LIFO reserve adjustments. I like this as a test question because it really tests your knowledge of the difference between LIFO and FIFO, how the excesses accumulate over time, what a LIFO reserve is, and the adjustments that an analyst would have to make to toggle back and forth from one to another. So we make 3 adjustments to convert the LIFO to FIFO. So we're gonna increase the inventory by the LIFO reserve. We're gonna increase the tax liabilities for the tax rate applied to the LIFO reserve. And we're gonna increase retained earnings by the difference. So those are profits right there. If ever we wanted to toggle from LIFO to FIFO, we would just increase retained earnings by the difference of the inventory tax. So our office walk us through an example for Caterpillar's LIFO to FIFO switch. They increased inventory by 3.3 billion. They increased their tax liability by round up to $700 million. That's based on an average tax rate of 21%. And the net effect of that increased retained earnings by $2.6 billion. Just right there, laying on the balance sheet. It's an accounting transaction. It's all paper. Nothing really happened. We just booked, we just found $2.6 billion in profits. And I find that remarkable. This is where the part of accounting for financial statement analysis gets interesting to me, but you got to dig pretty far into the 10K filing to find stuff like this. Okay, let's talk about a term called LIFO liquidation. We went through that example a moment ago where we sold 500 units and we had to go back through the lots. In that example, we had 2 lots. We had bought one lot, 250 units at a certain price, and another lot of 200 units at another price. Well, in reality, you're dealing with companies that have thousands of lots. They buy inventory every day, and they've been buying inventory every day for the last decade, maybe 2 decades. So their warehouses do fill up. And during a period of inflation, if you're using the LIFO inventory methodology, and you stop replenishing your inventory a little bit, so it's last in, first out. So last in, I mean, that this bought it today, I'm gonna transfer it over to the income statement. That becomes cost today. Well, if you stop buying your inventory, you start eating into those older lots that you have laying around in the warehouse. Now maybe you're selling inventory that was bought 6 months ago, 9 months ago, 2 years ago. In a period of rising inflation, what happens to those costs as you eat into those older lots? Well, prices were cheaper 6 months ago. Prices were cheaper than that 9 months ago. Prices were cheaper still a year ago. So it looks like your costs are going down. That little maneuver is called LIFO inventory, LIFO liquidation. So you might think to yourself, okay, well, I don't want to have to report to the world that I'm switching from FIFO to LIFO and dropping $2.6 billion worth of profits to the bottom line. Because somebody out there is going to say, no, I call shenanigans on you. That's BS. I'm not going to give you credit for $2.6 billion of profit that you didn't have anything to do with. No, it doesn't work. So you say, okay, well, maybe there's another way, because there's always another way. And you might think, well, I'll just subtly liquidate a little bit of those LIFO reserves. I'll stop buying new inventory so I can cost some of the old inventory, which was purchased cheaper. And you liquidate some of the older, cheaper reserves. Fewer costs flow through to the income statement. You're boosting your bottom line, and maybe nobody knows. Now, in this particular instance, it got so, the magnitude just became so large that, I think we're talking about Caterpillar here again. Caterpillar's auditors, Pricewaterhouse, whatever they're using, they said, no, you need to disclose it. Okay, so they disclose it in a footnote that I'm sure is buried in the back of the 10K filing somewhere. And they say in 2022, net income included gains of 367 million on account of LIFO liquidation. That's the type of disclosure that you would probably be able to hide from most Wall Street analysts. You can mix that in there without a lot of people crying foul on something like that. I mentioned this already, but I'll mention it again because I think it's important. My slide 21. Slide 21. Yeah, here, IFRS, so International Financial. What's the R stand? Prohibits LIFO. So if you're outside the United States, this doesn't exist, which may make you wonder, why don't we just do it like everybody else, and our lives would be easier tonight for module 5. But I like to turn that rationale on its head and think to myself, well, if accounting weren't so esoteric and opaque and complicated, we wouldn't have jobs. But because it is so esoteric and opaque and complicated, we have all this opportunity to find nuance and explain to the rest of the world what's really going on. And this is where we earn our money. Now that we know how the accounting works, now that we know how it potentially may be manipulated, now that we know how it works in a rising inflationary environment and in a falling inflationary environment, we need to follow all those financial statement changes through the ratios that we're looking at to assess the financial strength and solvency and credibility and profitability of the company that we're looking at, and also make sure that it's an apples to apples comparison against, well, if it's Caterpillar, we're looking at John Deere, if it's Home Depot, we're looking at Lowe's. We want to look at these data points across time and relative to peers. And that's where we glean the real insights into what's going on inside of these companies. Okay. So that was 40 minutes of lecture on LIFO, FIFO, and now our authors are starting to shift into, I just feel like they threw a bunch of stuff in this chapter that may or may not, no, are relevant. I don't really see a lot of logical flow into the next 4 or 5 topics, but we'll touch on them here real quick. Fortunately, most of them are pretty self-explanatory. The first one is gross profit margin. I guess we just talked about inventory costing, so that does affect gross profit margin. What else affects gross profit margin? Our authors highlight that here on slide number 26, and I hope you go down every single one of these bullet points and say, well, of course, just pick one. More generous sales discounts or sales return policy. Yeah, that's going to affect gross profit margin. Your job as the analyst is to identify when gross profit margin has changed and track it back to one of the bullet points on the screen. Maybe that's inventory profit. Maybe that's another one of these. That's where we really differentiate ourselves. That's where we earn our money as analysts. And we're going to talk about 4 or 5 different ratios. This is review. We've talked about days inventory outstanding. We've talked about it in module 2. Days inventory outstanding is the spot on formula. Start with our cost of goods sold divided by average inventory. Days inventory outstanding, we'll take 365 days per year divided by inventory turnover. And both of those give us a different lens, a different perspective on the underlying economics or fundamentals that might be driving changes in gross profit margin. When you see these numbers vary from period to period, ask questions. What's driving that? It's always what's driving that. This is a good chart to understand the capital intensity or just how much inventory it takes to drive sales in different industry groups. So look at, I don't know, take one here, food, beverage, and tobacco. Their days inventory outstanding is about 60. Compare that to transportation. Days inventory outstanding is about 15. So that's interesting. It gets more interesting when you zoom in, so you can look inside a specific industry, and then you can look at maybe 6 or 8 or 10 companies side by side, and you can start asking yourself, well, why does Home Depot have a days inventory outstanding number that's 50% of Lowe's? What's the difference in how they're running their business there? And are there any takeaways that we can gather from the way our competitors are operating? And that's another job available to a lot of basic grad, corporate finance, or might be a private equity role. You'll want to look at corporate strategy, and these ratios tell us a lot about corporate strategy, or at least they can tell us what questions we need to be asked. Tell me the reason why. Tell me the reason why company A is able to operate more efficiently than company B. Tell me the reason why company A is able to operate at higher profit levels, higher returns on invested capital, so on and so forth. And here are the numbers for Home Depot. When you take their financials and you plug them into accounts, well, I guess it's accounts payable turnover, so similar, different methodology. 8.4 times, days payable outstanding, 43.4 times. This is a component of the cash conversion cycle, which we looked at earlier in the year. And that's shown here again on slide 22, where we take days inventory outstanding, days sales outstanding, accounts receivable, days payable outstanding to get a cash conversion cycle. And you can see how Home Depot's, the cash conversion cycle went from 31 to 32 to 46. That's almost a 50% increase from 2021 to 2022. That's a big increase. What drove it? Let's look into the numbers a little bit. Well, the days payable outstanding, that actually went down. So that's a positive increase. The days sales outstanding, well, that's almost identical. Days inventory outstanding went from 70 to 80. So they're not turning over their inventory nearly as fast as they were just last year. Why not? Well, I suspect for a company like Home Depot, you got two components of that ratio. You got sales and you got inventory management, inventory turn. Inventory, I would imagine their inventory is pretty stable. So I'm guessing that had everything to do with sales. And 2022, what's going on? So you probably, was that 2022 or, yeah, 2022? That was 2021. So 2021 fully started, and then we did a bottom down for that.
Well, 2020, right?
Was it 2020?
Yeah. So I think
Because
it's
the Chiefs won in Miami, that's how I remember it. So that
so
was 2020.
Why the inventory was, turning so much faster than people were doing a lot of home projects, vaccines or something.
So you think it went the other way? You think sales increased in 2020 because of COVID? They were hot, so this is going down. So
Well,
sales spiked because of COVID. That's where
I seem to recall a lot of home projects were increasing because lumber was going up so
I
high.
recall that too, and now I'm just trying to match the time frame. I'll bet you're right. I'll bet sales spiked, and then kind of slowly, gradually normalize over the next few years. That's a good, that's the conversation that we want to have as an analyst. We're trying to remember back what was happening. It would have been embedded into the sales number, so, so that would affect, if you're looking at inventory and sales, inflation affects inventory, inflation affects sales, wouldn't really affect payables outstanding. But it's embedded in there, and that's one that's I don't know what the right word is, multifaceted, so to speak, where you can't really tease out the bottom line impact of inflation by looking at just those three numbers. You'd have to go a little bit deeper, but
People are.
so sometimes you hear analysts call that as like a demand pull forward, like, you know, if you look at the inventory of homes in the United States, and I don't know what the average age of a home is, let's just say 12 years across the United States. So you're gonna need some upkeep. Well, there are forces at play in the economy, like COVID, that can accelerate some of those home improvement cycles. But that's not what you think of as a secular trend that would increase the demand for home improvement. You're pulling a lot of that demand forward, so you get great sales in 2020, great sales in 2021. By the time you get to 2022, you've had so much demand that you've exhausted I guess the demand is the right word for it, and you get a little low. That's an overly simplistic analysis of anything that we're talking about, but hopefully it gives you a little bit of insights into how to kind of think through some of those questions. And then always go back to the 10K filing for your source document, and then you should be able to get additional insights from the investor relations team. So here's that same data just charted out. And again, a great reminder to throw all of this time series data into a chart for those same insights. Let's talk about property, plant, and equipment for a moment. Property, plant, and equipment can be, well, I'm not going to spend much time on depreciation methodologies. We spend a full module talking about depreciation methodologies, so you should all be familiar with straight line depreciation. And then our authors make mention of 3 different forms of accelerated depreciation, and I'll just let that slide speak for itself, because yes, we do spend a full module on depreciation. Okay, R&D costs. Find the slide confusing. There are very few instances where we will capitalize R&D expenses. And when I say capitalize, I mean, we're gonna put that on the balance sheet as an asset. Spend money, we put an asset on our balance sheet. It's debit, cash, credit, tax. Very simple transaction. That does happen when we build an R&D facility. So top little point on this slide, if we're building an R&D facility, we expect to conduct many R&D projects. We're gonna put that on our balance sheet as an asset, property, plant, equipment. Now, forget you ever heard that. because it confused me. I remember this was early in my career too. I think it was 1999. I was interviewing for a job with Stanford Bernstein in Midtown Manhattan. And they ran me through 4 different interviews. And they had a lot of technical interview questions that they would ask you. How many ping pong balls will fit in a 747? So the answer to that question, they want to see you read. So, okay, 747, 180 seats. So let's say you got an approximate 20 cubic foot refrigerator that would occupy the same space as a seat. So a ping pong ball being maybe 1 cubic inch, 20 cubic foot refrigerator, that X number of ping pong balls, do the math, times 180 seats. Add 10 for 2 galleys and another 10 for the cockpit and two restrooms, and reason your way all the way through that, you come up with a number of 10 rooms. That's neither here nor there. The question that I failed on miserably was, how do you account for R&D expense? And I don't remember at the time, so necessarily capitalizing R&D related software. Again, forget you ever heard of it. The answer is always R&D 99% of the time is always going to be immediately expensed, which creates opportunity for shenanigans, because if you're a management team and you ever need to find earnings now, it's easy to cut R&D. It's not like, I mean, it's a little bit like inventory can be manipulated, but then you're just taking expenses out of the balance sheet. And companies do this all the time, which is why I encourage anybody that's working on pharmaceutical company, technology company, anybody that has R&D as a significant portion of their, they need to track that over time as a percentage of sales. They need to track that over time as a percentage of assets. And anytime you see it wane over a period of a year, 2 or 3, that should shoot up a little pink flag to find out the reason why R&D expenses are starting to decline. Because that can be a harbinger to negative earnings reports in the future. Okay, asset sales, impairments, and restructuring activities. I thought this was fun. I'm on the wrong slide. So in this scenario, we're talking about the sale of an asset. So pick a piece of property that we have on our balance sheet, property, plant, equipment, what have you, we're gonna sell it. So in this instance, we're looking at T-Mobile, and they sold an asset and recognized a $1 billion sale on the wireline asset. The bottom bullet line on here says, assume that these assets are sold near year end, have been in use over the prior 10 years. Well, often we're suggesting that you go back and you adjust the last 10 years worth of financial statements. You could do that. My question is, why would you do that? Who's the user that needs to see the financial statement restated over the last 10 years? So the argument here is that, well, if you just made $1 billion profit by selling an asset, then over the last 10 years, that asset was understated by $1 billion. You could restate it, recast the financial statements, and all the accompanying ratios and schedules that go along with it. My question is, okay, fine, yeah, why? I can't think of a use case for that. Who's the user? Are you a stock analyst? Are you a bank? Are you an internal user? Are you a CFO? What's the use case for that? So yes, if you sell an asset and you book $1 billion gain, sure, you can restate it. But why? what's the reason why? I don't know the reason why. You're walking us through a scenario that I've never encountered. Most of the time, I know the reason why, because you need to compare apples to apples. But for a company like T-Mobile, you're comparing them to AT&T and Verizon, and a $1 billion gain to a company that size, it's not that significant. Okay, let's look at asset impairments. In this instance, it's not a gain, it's an oops. Anytime the company writes down a piece of property, plant equipment, you got an asset on your books. At the end of the year, you do an assessment, you hire your accounting firm to do an audit and evaluation of those assets, and they say, well, you got a trademark, you got a piece of goodwill, or you got something else that needs to be written down. It's on your books at $1 billion, it should be $500 million. So you're about to take a loss. That loss signals to investors like me, somebody made a bad decision. Maybe that was the current management team, maybe that was the former management team. Somebody made a bad decision. I can tolerate one or two of those, but I can't tolerate a series of those. Because it's an indication that we're doing business with people who don't know how to run a company. So, and I raise it as a potential pink flag because sometimes that does become problematic. Word to the wise, when you all are installed as the CEO of whatever company you want to be CEO of, you'll see this little flag come out of the play. Sometimes, and this is the way it's typically works, this is very common. New CEO will come in, and the board will award them an option because they want to align their interests with the interests of long-term shareholders. And all of those options have a strike price. And that strike price typically has a formula associated. That formula equates the strike price to the average trading price of the stock during the 60 to 90-day period after the CEO comes on. Then they do that to take some of the volatility out of the stock price and just identify the onboarding period for the new executive. Fine. But you're the new executive. You have control of some stuff. So what do you do day one? You tell a story. And that story sounds something like this. Well, I'm thrilled to be here. This is very exciting for me and my career. This company has a long history of serving our constituents well. I think we can do some really great things. Unfortunately, some of the ventures that I'm taking a look at, they're not what I had hoped they'd be. And I'm announcing a restructuring project that's going to require some asset write-downs. What you're gathering up all the bad news and you're throwing it out there as a big earnings bomb, and you're driving the stock price. It's great for you because you just took the job as the CEO and your options are vesting or striking over the next 90 days. So any negative news that you can lead with is great for you. So let's look at and let's find every bad decision that the former management team has ever made in their entire life. Let's drag it out of the closet, let's sell it, let's take the loss today. And let's plant our flag at a low vesting price. And then over time, so restructuring costs. So let's say we restructure a unit. Asset impairment is pretty simple. There were a couple more slides on that, but I want to talk about restructuring because it's where CEOs really go to manipulate this example that I'm throwing out. When you restructure a unit, the restructuring costs are reported today. They hit the income statement today. And the restructuring costs have three components: employee severance, the relocation costs, asset write-downs, which we just talked about, and other restructuring costs. 1, 2, and 3 are all estimates. They're all estimates. Employee severance or relocation costs. When you restructure a division, you don't know how many employees are gonna be severed or quit or relocate. You can make some estimate, say 50% or 60%. When you write down an asset, you know what its book value is today, but what you're writing it down to is an estimate of its fair value. And then other restructuring costs is this huge wide ranging category that could include almost any extent. My point here is, this is a great opportunity for management to play games with cookie jar accounting. So you're a new CEO, trying to drive the stock price down, you restructure a unit, you estimate all 3 of those on the high side so that your losses are gonna be bigger than what they'll probably ultimately end up being. That's cookie jar accounting, because you've just hid away some losses that won't materialize. Restructure the division, find out, oh, well, we were too conservative, we wrote the asset down too much, not as many employees were relocated, and our other restructuring costs were estimated aggressive. Okay, so now you're probably 12 to 18 months in the future. At some point, management announces to Wall Street that, remember those restructuring costs that we took as losses a year and a half ago? Well, we were overly aggressive in our, so we're gonna reverse some of the restructuring. How do you reverse the restructuring? Ultimately, it flows through to the income statement in the other gains and losses. So it flows, it's not operating income, but it is an other gain, and that shows up in net income, which affects all of your ratings. So one of the key themes that I hit on throughout this class is the importance of analysts focusing on operating income. Because operating income is typically a better, truer, more accurate representation of the underlying economic earnings power of the business. And certainly it would sidestep accounting shenanigans like this one. Okay, the last thing I wanted to talk about tonight was back here on slide 66. Our authors go through property, plant, and equipment, and the property, plant, and equipment turnover ratio. Pretty simple stuff. Acquiring intangible assets. See this all the time. Business A buys business B, pays way more than book value for business B. Say book value is $1 billion. Business A buys business B for $10 billion. Well, you can take business B's balance sheet and discreetly identify everything on the balance sheet as being, check. We bought all these warehouses, we bought all these vehicles, we bought all these other tangible assets. And those are all worth $1 billion, just like the company told us they were. But we paid $10 billion. So we have to plug that hole on our balance sheet. And in order to do that, we typically look for intangible assets. Because if the company B is worth 10 billion, then there must be something going on inside of that company that makes it worth 10 billion. And those are most commonly intangible assets that are valuable, but they were never purchased in accordance with any accounting. Whole list of them right here on page 60. Marketing related assets, customer relationships, artistic related assets, trademarks, patents, so on and so forth. If we can identify any of the value to those assets, we will do it. That's all a big estimate, which is fine. That's all disclosed in the filings when mergers and acquisitions happen. To the extent that none of these intangible assets can be traced back to the purchase price, we're gonna throw any excess into a big bucket that we call goodwill. And you see that all the time on the balance sheets of companies that have had any history of mergers and acquisitions, and our authors take us through A&B's purchase of Xilinx. 2022 or something. So A&B bought Xilinx for $48 billion. And if you look at the cost assessment or the I guess cost assessment, you can see that the purchase price was allotted to cash, 2.3 billion in cash. That's an easy one. Short-term investments, accounts receivable, inventory, so on and so forth. Those are the balance sheet items. And then you'll see $27 billion. Look for the largest number in the top half of the page and pan over to acquisition-related intangibles. So AMD went through that list of intangibles on the last page. And they identified $27 billion of value associated with those intangibles. Beyond that, and all the way down to the second line up from the bottom, and you see goodwill. Goodwill posts as a $22 billion number, and that's the plug figure. AMD paid 48. They got everything on the balance sheet. They were able to track back $27 billion to intangible assets, and then they were still left with a $22 billion hole that they had to plug with goodwill. And that goodwill is going to sit on their balance sheet forever, subject to an annual test of whether or not it's still worth $22 billion. And that annual test is done by the auditors, and it looks a lot like what we're doing in this class throughout our 16 weeks. They're going to value that portion of the company. If the company is still valued in excess of that 22 billion, minus the assets that they can discretely identify, then it'll sit there forever. The intangibles that they were able to identify are shown here on this next slide. They included developing technologies, customer relationships, customer backlog, the associated amounts, and a useful life. And that useful life will be applied to those assets so that they can be amortized or depreciated over their useful life. So it's almost identical to the manner in which we depreciate a piece of property or plant or equipment. Now, how do you identify the value of those intangible assets? And our authors, the text authors, give us 4 or 5 different methodologies that you might see if you're out there in the real world doing this and you're part of an M&A team. Well, you might have to say, okay, well, what are those intangibles worth? One way to do that is by using the relief from royalty method. If this is a piece of software or other piece of tech, you might ask yourself, well, we bought this company so that we could execute on this strategy. If we didn't own this company and its rights to use this technology, we would have to go lease it or buy the royalties from another company. If we bought those royalties, they would cost X. Okay, that's an approximation of the value that we receive when we buy those. And multi-period excess earnings method, you could ask yourself, okay, well, what are the earnings expected to generate in the future with this merger and without this merger? And you compare those two numbers and you have yourself another valuation. Oh, okay, I think that's it, man. Yep. That is everything I wanted to cover from module 6. So, Zoom crew, thank you. Any questions before we call it a night? Okay. Thanks, Zoom crew. I'll try to
Hello,
get this.
Professor.
Yeah,
Sorry,
for
I
it.
just have a no, it's not a question, but just like something to like talk to you about after class, if that's okay with you. I don't want to speak about it in front of class, if that's okay.
That is
I can call you
okay.
on your phone if you'd rather do that instead.
Well, you're on speakerphone, so the whole
No,
class.
I got you.
Yeah, so
I understand that, but yeah.
yeah, just call me on my mobile. You got my number.
Okay, appreciate it.
Yep, all right.